In this video, I'm going to talk about the accounting for marketable securities using the stock market example in your textbook. So what's ending up happening is that the company has excess cash, so it purchases 100 shares of Choose Wisely for $50 a share. So 50 times 100 is 5,000, so you debit marketable securities. It's, in this case, a current asset because they plan on selling them within the year, and then you credit cash. What ends up happening at the end of the accounting period, companies are allowed or required actually to adjust their marketable securities so that their ending balance is based on their fair value at the end of the accounting period. That meaning, unlike equipment and land where you're not allowed to adjust those balances at the end of the accounting period to what you think they're worth, in this case, because these securities are marketed, i.e. they're being bought and sold regularly, that at the end of the accounting period you can actually see what they are worth. So there's an exception to the cost principle when it comes to marketable securities. So in our example here, the company looks up the price of the shares of Choose Wisely and finds out that they're not selling for $50 anymore, they're selling for $52 a share. So it's gone up by $2 a share, so they have gained $2 a share times 100 shares, or the value of their marketable securities has gone up by 200. Debit marketable securities, that'll get it so that the ending balance is 52 times 100, or 5,200. The other side of the entry is to a unrealized gain in this case because the price went up. Now, as far as it's called unrealized because they haven't actually sold these shares. Now, this could have been the opposite. The price could have fallen, let's say, by $2. If that was the case, this entry would be reversed. We would be debiting the unrealized gain loss because it's a loss, and we would be reducing our marketable securities by crediting them. But in this case, the price of the shares went up. So what ends up happening, we'll go over here and see what it looks like when you post. So again, they went, this is the 52 times 100 shares, so they had to increase it by 200 by debiting it. The corresponding credit went to the unrealized gain, making shareholders' equity go up. Now, had it been, like I said, a loss, the marketable securities account would have been credited, and then this account would have been a debit. Now, at the end of the accounting period, all your revenues and expenses get closed into retained earnings. In other words, you close net income. So along with your revenues, gains, both realized and unrealized, will get closed when you close net income. And that would mean that these two accounts in this example would be debited to close them out, to zero them out. If these had been losses, you would do the opposite. They would have debit balances had they been losses, and to close them you would credit them to zero them out. So that's how that works.